Hey everybody, it's John King. It is Friday, the 27th of June. We are headed into the end of the first half of 2027. What 2027? 2025. 2027. Anyway, we're heading into the final few days of the first half of 2025. And if you haven't figured out, I have a different background right now because these fun little things behind me are crutches. I broke my ankle the other day. So you're going to get my home office because I'm not going to the office until I can walk normally. Anyway, enough about me. Let's talk about you. Let's talk about the market. Let's talk about what's going on in today's market. So my number one topic today is it time to buy the dip? Is it time for you to look at the market and pull the trigger? And I want to speak to those of you who are thinking about buying a home, not just your primary home, because I've got a lot of clients over the last few years that have been looking at buying primary homes. But more importantly, is people who are thinking about buying a vacation home, people who are thinking about buying a rental property. Is now the time to buy the dip? And I want to share with you, I literally just 15 minutes ago got off of the phone with a client who gave me permission to share this story with the names being changed to protect the innocent. And she was talking about the fact that she's ready now to buy an investment property. Now, this is a property that she's been wanting to buy for her family, really for over a year that she's been looking. She's been trying to find the right property and the right situation. And now she realizes it is time to pull the trigger. Now, she's going to use this property as a vacation rental, VRBO type of property. She's going to use it partially in between as a home for her family, both her personal family and her extended family to use. Beautiful property on the river. And we were talking about timing and what's changed in the last year. And she said, John, prices have dropped in this particular region of Northern California. On similar homes, she saw selling for $50,000 higher. Now, the price point here is, $400,000 to $500,000 price point. And she saw homes that right now are selling for $450,000 that a year ago she would have seen in the $525,000 to $550,000 range. There's a house on the market right now for $375,000. She said, John, 6 months ago or a year ago that was $425,000 to $450,000. So $50,000 to $75,000 price drop. Now, is that really a price drop? No, because a lot of those sellers that had those houses listed at that higher price never sold them. They were pricing it based upon what they thought the house was worth and what they thought they could get for it because of the irrational exuberance. The irrational exuberance I'm talking about is buyers saying, hey, I'll take anything. And we had that in 2020 and 2021. And then we kind of flattened out in 22 to 24. And now since late 24 until now, it's been a little bit more of the buyer sitting back and saying, I don't know. I'm not sure this is what I want to do. I'm not sure that I'm willing to pull the trigger on this. And we're seeing, as you've heard me say many, many times over the last few weeks, we're seeing more inventory that is on the market and it's staying on the market longer. Now, this is all very, very geographic. Some regions are going to have houses moving very quickly. In every region, a well-priced home, well-staged, well-marketed is going to sell quickly and likely over asking price. But there's a lot more homes that are sitting on the market, a lot more sellers that are fearful and desperate, and they're lowering their prices. And part of it has to do with what's going on with the economy. So we're seeing prices soften. Inventory, there was a scarcity of inventory before, and now we're seeing more and more inventory that's coming around. And so the question is it time for you to buy the dip? Well, the question is, buying the dip simply means you're buying as prices have fallen before they go up. And ideally, you're buying at the bottom of the dip, except you never can actually tell when you're at the bottom of the dip. And so this is a situation where you've got an opportunity to start looking in a market that could soften further, but you won't know it unless you wait too long and it starts going up. You never know you hit the bottom until you pass the bottom. But what you do know is you're getting a better deal today on most of these homes than you were getting 6 or 12 months ago. And so to me, that's a huge win. And anything beyond this is greed, is you waiting and being greedy and hoping that things are going to get better. But things have gotten better. And a year ago, you would have said, I'd do anything for prices to be down $50,000 in this market. And yet you now have that opportunity. Okay. So it is, here's Okie Dokie asking a question about Orange County market. I'm seeing it statewide and nationwide, Okie Dokie. So I'm licensed in 12 states across the country. And I help people even in the states I'm not licensed through my partners within my company. And I'm seeing it nationwide. We're seeing prices soften. We're seeing, and again, I don't see a crash coming. We've seen cycles of prices going up and down for years and years and years. What you have to recognize is what happened in 2008 was a very unique set of circumstances. It was an economic downturn caused by the mortgage industry, caused by real estate, and it had the problem of what we call the domino effect. That when one person lost their home, the next person was the next to fall because everybody had adjustable rate mortgages. Well, that's not true anymore. Everybody today has fixed rate mortgages. So even if prices drop on some homes, the people who are willing to continue making their payment, as long as they didn't lose their job, they can keep making their payment. The dominoes don't happen. So we're not going to see that domino effect. So we're not going to see the significant contagious problem that we had in 2008 to 2011. But I do see prices softening. And I don't know. I'd be lying if I said, and this is going to last only a couple of months and you need to do it now. I don't know. I have absolutely no idea. Okay. So Okie Dokie also mentions number 20 on the waiting list. Hope it doesn't end. Combined income. Okay. So that part, I will tell you, I am doing a special broadcast tonight at 5:15 about Dream for All. We've got some news about Dream for All. I want to share that tonight. So what I'll tell you is congratulations on being number 20 on the list. I've got a lot of information I'm going to share tonight. So 5:15 Pacific time, if you can make it, join me at that time. And I'm doing a special broadcast that is going to be specifically about Dream for All right now and the future of Dream for All. And so I'll be sharing that information at that point in time. So I'm going to go back to my regularly scheduled programming. And let's talk about what's happening really with interest rates right now. So we're having a lot of rate volatility. If you are someone who has just gotten into contract or you're writing offers right now, this is one of the most volatile times of the year. And it really happens 4 times. So 4 times a year, we hit the end of a quarter. And the end of a quarter is a really, really big deal. End of the year is an even bigger deal. Okay. And what happens with that is that you have bond funds. Bond funds are mutual funds, index funds, not index funds, but money market funds, etc. They have certain target requirements of a balanced portfolio. So you probably have a fund in your retirement account that might be the 2045 target retirement date fund. And that kind of a fund specifically says this percentage of our fund is going to be in bonds, this percent is going to be in low risk stocks, this percentage is going to be in high risk stocks. They have to maintain that percentage in order to be able to advertise that's what the risk level is. But guess what? Things don't grow evenly. So if one category grows, let's say, for example, the blue chip stocks, I'm just giving a simple example here, they grew a whole lot. Well, then the percentage of the portfolio is imbalanced. They have to sell some of those stocks to buy some bonds so that the numbers are perfect on June 30th. Because June 30th is the day that they close out the quarter. So at the end of every quarter, you see a lot of trading on Wall Street. Now, why am I saying this? Because Wall Street trading, they trade stocks and they trade bonds, and mortgages are a bond. So we are seeing a lot of volatility. Not only do we have war that we're dealing with, or hopefully resolved, the potential of war, we've got the economic issues that we're dealing with, we've got the fight between the President of the United States and the Federal Reserve Chairman, but now we also have the month-end rebalancing. And so these big corporate investment firms, they have to sell stocks, not because they want to sell them, but because they have to rebalance. And then guess what they do on July 1st? They buy back the ones they wanted. And so you see a lot of volatility, which means over the next 2 weeks, we're going to see a significant amount of volatility. The hard part is it's hard to say if it's going to be up or it's going to be down. So my advice, if you are looking and you're in contract, you're about to be in contract, if you like the number, lock it, because there's no way anybody can tell you what the numbers are going to bring over the next 2 weeks, because the big picture considerations mean less at the end of a quarter. Because at the end of the quarter, it's more about, hey, it might be a great idea to own a whole bunch of Tesla, but this particular fund owns too much and they have to sell a whole bunch of it. And then they're going to buy it back after July 1st. So you're going to see weird stuff. I'm just going to let you know now that if you're at the place where you're pulling a trigger on buying a home and you need to lock, you're going to see a lot of volatility because of the fund flows. Okay, so we're dealing with the question of, do you lock or do you float? That is a very, very important question that a lot of people ask me, John, should I lock or should I float? I can look at the big picture. I can look at inflation. We got an inflation report today that shows inflation is back up. We're a little bit higher in inflation, and the Fed's very, very worried. Jerome Powell said it last week, very worried that inflation is going to show up in June and July from the tariff numbers that were put in place back in April. And so now what we're dealing with is a little bit of, see, here it is. I told you, and the market's reacting. So we saw rates bump up a little bit today. And so that becomes a, well, is that a new direction or not? Well, now we got next week. 7 days from now, we've got the next jobs report, that's going on. And the jobs report has been showing that, hey, jobs are fine. Like the Fed has been saying we have to keep rates high because jobs are fine. Jobs are in great shape. We're adding jobs. Unemployment rate isn't so bad. We're in really, really good shape. And we're worried about this inflation thing. We don't want to get egg on our face again because of 3 years ago when they got it wrong about inflation and it took off much, much faster than they had ever expected. And so now the Fed's in a really, really tight spot where they really can't win, because here's the other problem. We've got all these headlines that are talking about unemployment and talking about the fact that unemployment looks good, the economy is strong, everything is great. And I'll tell you, I'm talking to 2 or 3 people a week right now that are having a hard time finding a job. I'm talking to a couple of people who are thinking about shutting down their business because they just can't get the revenue if they're self-employed. And those are bad signs. Like those are concerning signs to me. Now, it may not be showing up in the national headline numbers, but here's the problem with the national headline numbers. They're based on statistics. They're based on the federal government picking up the phone this week and last week, calling corporations and saying, hey, did you hire anybody last week? And so if they called 2% of the companies across the nation and say, did you hire, how many people did you hire or fire in the last month? They take that number and they extrapolate that out to the entire United States. So there's a lot of guesswork that goes on there. And part of Trump reducing the cost of the federal workforce, part of Musk being, what the heck was that program, whatever it is Musk has been doing, that he's no longer part of, that is lowering the expenses from the United States. They've laid off a lot of people who were making those phone calls. So now the numbers are even more of a guess. So the fact is they're not even calling it the same percentage of companies. And so this number that comes out next Friday is really, really important to the Federal Reserve, really, really important to the stock market and the bond market and the mortgage world, but it's even less reliable than it ever has been. And we are dealing with what I'm hearing on the street from clients, an economy that's starting to shift, an economy that has been shifting. And so the question is that going to start showing up in the numbers or not? If inflation stays where it's at and unemployment gets worse, we're going to see interest rates come down. Okay, so really I want to circle back now to what I had said originally. Actually, I got a comment here. Let's see what my comment is. Doge, thank you, okie dokie. I don't know why I couldn't think of Doge. The Department of Government Efficiency, Doge. They did their thing and they laid off a bunch of people. Again, I'm not saying it's good or bad. I'm just saying it's the truth. And they laid off a bunch of people. So let me close with where I started. So 2 things. A, if you missed it in the beginning, there is some big news that I have about California Dream for All. I'll be sharing it tonight at 5:15. So make sure that you check back on my Dream for All channel. You'll find the live stream right there. Secondly, is I was talking about buying the dip. And so here's the deal. If you are thinking about buying the dip as an investor, a couple of things I want you to know. It's a lot easier to qualify to buy investment properties now than you may have imagined or than it used to be. There are programs that take common sense into account and say, hey, how much money are you getting in rental income from this property? And as long as that's enough to pay the mortgage payment, we're able to qualify you. Okay. There's a lot more flexibility. Your down payment amounts, if you have good credit, you have good income on your tax returns, you can put as little as 15% down on an investment property. Most people think it's going to be 20, 25, 30, 35% down on an investment property. You could put as little as 15% down on an investment property. You could look at buying a multi-unit property. I've got a buyer right now buying an 8-unit property, and the property is cash flowing about $2,000 a month into their pocket. So it's a great opportunity, and it's much easier to qualify. They actually ran into problems with their bank because they have a new business that they've opened. They have an existing business, they're opening up a new one, and the bank said, we don't trust that your new business is going to make money, and we're afraid you're not going to be able to afford to pay for all of it. And our program says, I don't look at anything except the income from the property you're buying. So you have a lot more flexibility. And so if you thought you couldn't qualify, if you thought it wasn't a good time, it is a good time, and you may in fact be able to qualify that you didn't think. So guys, I want to be really clear. I am interviewing to be your lender. So if you have questions about anything, I do these to keep you updated, but I also do them to have you really be impressed by me and want to work with me. And so right up here, you have a QR code. That QR code gets you to my my mobile app or website. You can book a consultation there. You can start the process. I am interviewing to be your lender to guide you through the process from start to finish. And I look forward to being here to take great care of you. Okie dokie has a couple of other things here. You are saying regarding Dream for All, is it positive or negative? I'm not sure I want to hear the negative. Well, you're going to hear it either way. So I don't think you'll be upset. Let me just say it that way. So I'll leave you with that, guys. I hope you have an absolutely wonderful rest of your day. And for those of you who care about Dream for All, I'll see you at 5:15 tonight. Have an absolutely wonderful day, and we'll talk to you all soon. Bye-bye.